Welcome to the Three Edge Week in Review for the week of December 5th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. This week, Steve and I will discuss the current disagreement among investors as to whether the Fed will be able to engineer a soft, or at least a soft-ish, landing for the U.S. economy while they continue to tighten monetary policy to combat inflation, or whether a recession in 2023 is inevitable. A quick look at market activity, and on the first couple of days of this month, the S&P actually broke through the 200-day moving average, which can be a bullish or positive indicator. And, basically, I think that was based on investors rallying, if you will, behind this narrative that the Fed would soon be able to pause its program of raising short-term interest rates to combat inflation. And it is the case that the Fed indicated themselves that they're going to raise short-term rates by only 50 basis points next week at the next FOMC meeting. And that would break their streak of having increased short-term rates by 75 basis points for the past 4 consecutive meetings. However, this does not necessarily mean the Fed would be finished raising rates and tightening policy in 2023. And I guess as evidence of that, the S&P spent only a couple days above that 200-day moving average. Investors' hopes were at least temporarily dashed on the rocks of the jobs report in November, which came in higher than estimates. The employment report seems anchored at a very low 3.7%. And maybe the most troubling feature of that jobs report is showed that average hourly earnings had increased by 5% from the same time last year. And then yesterday, the Bureau of Labor Statistics released the Producer Price Index, which measures inflation at the wholesale level, which would be from the standpoint of industry and businesses, as opposed to the Consumer Price Index, which measures prices paid by consumers. And that report also showed that producer prices were up by 7.4% from a year earlier, once again higher than consensus forecast. So these data points certainly seem to indicate that inflation may not be going away soon. The Fed will need to keep interest rates higher for longer in 2023. So let me bring Steve in here. And Steve, let's get started. And, as I mentioned, there's a lot of disagreement, or I think maybe sometimes you refer to it sort of as this battle going on, if you will, among investors as to whether the Fed will be able to engineer this soft landing, slow the economy just enough to get ahead of inflation, but not tip it in to recession. And if they do that, I think we're going to refer to that as the Goldilocks scenario. And obviously, that's what people would prefer, and it would justify higher stock prices. But so maybe it would help if you could just explain, all right, what would the factors be that would enable that scenario to play out?
Well, Fritz, the idea behind Goldilocks is that the economy is not too hot, not too cold, but just right. And that's the bullish scenario. I agree with you. When I read the financial press, I've seen even more disagreement between the bulls and the bears than normally. And so if I concentrate on the Goldilocks scenario and I summarize what that is, it's the idea that the economy has shown resilience already, as evidenced by low unemployment rate and continued strong corporate earnings. And this should be able to get the economy through any soft patch. That inflation seems to have peaked, and that maybe after one more rate hike next week, the Fed will meet and announce on December 14th. It will most likely have one more hike, but maybe that's it, and they pause from there. So that's the scenario that says the economy's not too hot, not too cold, but just right. And some of these analysts think the bull market is already underway.
All right, fair enough. So now let's look at the other side of that coin and another possible scenario, which is let's consider the possibility that perhaps the Fed raises interest rates, tightens monetary policy to such a degree that they tip the U.S. economy into recession in 2023. So what would be the factors that would contribute to that scenario, which obviously is not what people are hoping for anyway?
Well, Goldilocks confronts the bears, and the bears are convinced that the bear market is still intact. And we talked about a moment of truth at a previous video. And we know that from observing many past bear markets, that there are always these sharp rallies during the bear market, and they create a lot of hope. And they run up against the 200-day moving average. And then they might flirt with it or even go up above for a little bit and then falter and then punish all those who had that false hope and came into the market. And then bear market continues, we go to a new low. So here's the summary of the bear market scenario, that monetary policy typically operates with a long and variable lag. And we've seen great tightening of interest rates and shrinking of the balance sheet during the year 2022. But because of the long lag or delay, we're not even seeing any real impact from all that tightening. We won't until 2023 unfolds. And maybe the first evidence is in Q1 of 2023, which is just a few months away. We'll get a batch of corporate earnings reports that will be disappointing. And I want to refer back to a chart we've used before. We call it the three phases of a bear market. Phase one, we've already had. Phase two is when it moves from just a break in the price trend of the market to investors worry that, hey, this is more fundamental. Corporate profits are no longer going to continue to be so strong. They're going to weaken. And that's typically what we call phase two of a three-phase bear market. So we might just get into that next year, and that'll be still midstream of a longer bear market. So the idea is that inflation doesn't nicely come back all the way to 2% like the market expects. We're going to need more Fed rate hikes beyond December 14th, and that people will look back and say, remember that rally in November and into December? That was just another typical bear market rally that failed, and all that false hope now just caused punishment for all the new money that went back into the market.
Excellent. So, as always, my final question is, based on the two different, very different potential scenarios that you just laid out for us, how does an investor then think about positioning their portfolio going into 2023?
So I think it's important to remember that markets, in the future course of this market, is not predetermined, because the future course is going to depend on decisions that haven't been taken yet. And this cuts across many different forces and many different constituents. But just as an example, Federal Reserve Board still hasn't decided yet what they're going to say on December 14th, although that's coming close. They haven't decided yet what they're going to do in the subsequent Fed meetings in early and mid 2023. And there are two warring camps within the Fed. There's a lot of internal disagreement. There's one camp that says we have to fight inflation at all costs, forget about recession. We need to keep raising rates. And there's another camp that says, I think we've done enough, and let's not unnecessarily hurt the economy. And we don't know which camp inside the Fed is going to win over the final consensus and the decision from Fed Powell. So we have to be careful that we don't get set in just one possible scenario, but we realize that there's an opportunity for different future scenarios to play out. Having said that, there are things that we know from our research that are very important. And so one, I'd like to look at another chart, and this is an update of a chart we've seen before. We call this our price to sales chart. And what we know is that looking at price to sales ratios, or the price that investors pay for a share of that stock market compared with the sales revenue that equivalent share produces, those companies produce, we see that, as one would expect, when investors overpay for a given level of sales revenue, returns over the subsequent 10 years are always below average. And when investors get a bargain and underpay for those same sales revenues, returns over the following 10 years are always above average. And it's been a tremendously predictive relationship. Doesn't tell you what's going to happen tomorrow or the next day, but it gives you a sense of what the future potential is. So one thing we can think of is that the risk of a bear market is still with us. Inflation hasn't decidedly been licked. It's been helped recently by energy prices coming down. But some of that's been because the Strategic Petroleum Reserve in the U.S. has been releasing lots and lots of barrels of oil. And that's going to end soon, because once the price of oil hits 70, they're determined to start buying again. And they need to pretty soon, because we've already released so many barrels. So we might not get that help inflation anymore. And there are other aspects of inflation that are sticky, like wages and food. Food inflation is still high. So we might not get that Goldilocks scenario. And what that means is that in the U.S., sure, if we do get a temporary Goldilocks scenario, there's nothing that prevents an overvalued market from continuing to go higher. You can see in this chart, even with the downturn this year, we're still in rarefied territory, still highly overvalued.
Right.
And so you can say that by buying heavily into U.S. stocks now, yeah, you can in the short term go from an overvalued to an even more overvalued state, but that's not really sustainable. And there's a lot more downside if the bear market scenario plays out. On the other hand, there's an intelligent way to hedge against the potential of the global economy doing better than people expect, and maybe the stock market coming back. And that is non-U.S. stocks. They're all the way on the other side of this chart. They're in very deep, many of them are very deep undervalued territory, at least fairly valued. And so by tiptoeing, as we already began with emerging markets, by tiptoeing into some non-U.S. stocks, we can begin to set ourselves up to appreciate our portfolios as bull market might start to take hold at some point, and where there's limited downside, but potentially more upside. Now, the other thing is that the strong U.S. dollar over the year has been particularly painful for emerging market stocks. And we've noticed recently that the U.S. dollar has peaked and has started to come down in a pretty serious way. So we think all else being equal, this could help some of the emerging market stocks whose prices have fallen so far that they've already priced in so much bad news that, again, there could be more downside, but it's relatively limited. And if things go better than expected, these have more upside. So I think that's important. One other thing I'll say is gold. If the dollar continues to fall, if the Fed is going to pause at some point before the war on inflation has been won, either because of some financial accident like what happened in the UK or for some other reason, then gold would be an excellent hedge and could have some serious upside.
Excellent. Great. Thank you very much for that insight. And I guess if my takeaway is that, just as you explained, when you're investing for long-term success, you have to be able to consider multiple potential economic and market scenarios. And actually, it also makes me think it's very nice to have the global capital markets that we use to rely on, so we can look at all the potential different scenarios that may arise. But that's very, very helpful as we close out 2022 over the next few weeks and enter into 2023. So that will do it for Steve and me for this week. As a reminder, all our videos are available on our 3Edge YouTube channel, and all our videos and all our written commentary are always available on our website, and that's at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.